Would you like to be able to get a 3% investor loan to buy your next property? But hey, you've been told that those don't exist anymore and that your only interest rate is 7 or 8%. Well, listen, the people that have been telling you that, well, they're not telling you the whole story because there's a completely different side of the market that's available to you right now that is being ignored. And what I'm referring to is the VA loan assumption program. Listen, this is a strategy that lets you, yes, even you, if you're not a member of the military, someone who's served in the military, take over a seller's existing mortgage at their original interest rate. So here's what I'm going to do. In this video, I'm going to break down for you how to actually do this to set it up the right way and make sure you're protecting yourself on the back end. All right? Let's get started. All right, so the problem that we run into as real estate investors in this market is you have sellers who want pandemic prices, but banks who are not offering the cost of capital, the interest rates during that we had pre-pandemic or during the early parts of the pandemic. So this is a mismatch. It makes it really difficult for investors to get into cash flowing properties. I mean, if you go to a bank for an investment loan, you're typically looking at 7.5 or 8%. And on a $400,000 loan, that's a mortgage payment easily of $2,800 a month. And on many of these deals, listen, I've been looking at them, they kill your cash flow. You have one turn, you've lost money for sure. So it turns what would have been a winning rental deal possibly into a liability. But what if I told you you could step into the shoes of a seller, right? What if the seller bought the house 3 years ago and it was locked up at a 3% rate? You know, on that same loan balance, the payment may drop up to $1,600 a month. To $1,600 a month, and that could be a difference, of $1,200 every month back in your pocket of pure cash flow that does not go to the bank. Now, this strategy and this opportunity is real. You just have to find the right sellers. Okay, and the problem that you run into with this type of deal is on the execution. Now, maybe you've heard of buying property subject to before. And as I stated in my opening, we're not talking about subject to deals. What we're talking about is VA assumption loans, right? Knowing that these borrowers / sellers exist out there. And what you're going to do is you're going to walk through this legal mechanism where you can step in and assume their loan. Whereas with the subject to, you're not really assuming the loan, you're just taking over the payments. Now, I get it. You could be saying, well, Clint, if I do a subject to deal, I'm not going on the mortgage. Yes, but there's always risk in subject to deals. If you watch my other videos, I talk about this, where if the seller files for bankruptcy, you're in hot water. Or the seller does something that notifies the bank, and then the bank looks at the property and they see the seller no longer owns the property, you own it, that puts you in hot water and they foreclose. So what we need to do is figure out a way, or what you may want to do is look for these other types of deals where you eliminate that risk and you get this low interest rate loan. And I'm going to teach you how to do that to get into these deals. Okay, so let's be clear. At the very beginning, the biggest myth out there is that most people think that you have to be a veteran to have a VA loan. Now, that's only true for the origination process, but it's not true for assuming the loan. In fact, the Department of Veteran Affairs clearly states in its regulation that a VA guaranteed loan can be issued or assumed, that is, by any credit-worthy borrower. So you don't need to be in the military or have prior military service or even be the spouse of someone who's in the military. You just got to be able to pass a credit check, just like you would with any loan. Okay, and the governing rules here, listen, it's really simple. You can look it up. It's Title 38 of the Code of Federal Regulations, Section 364314. And this section outlines the entire process for the transfer of ownership and the release of liability for the seller. And that last phrase there is critical, okay? Okay, you're not just taking the property, the seller, unlike a subject to deal, is actually getting released from the loan. So the seller's name stays off of it, right? Off the mortgage going forwards because you take it over. It's a formal assumption process where you're substituting your name for the seller's name. So you no longer have to worry about the seller doing something that's going to get the loan called due as you do in a subject to deal because now you're actually taking over that loan. Now this matters, right? Of course, because as I stated earlier, when the seller doesn't have a formal release, that's always hanging out there. Now, the issue, though, that comes up on these VA loans, because you might be thinking, well, Clint, if this is so easy, why isn't everyone doing it? Well, many times with these types of deals, there's an equity gap, right? And so what the equity gap means is that, let's say that they have a loan on a piece of property they bought 4 years ago, and the debt on the property right now, the loan is for $300,000. But the fair market value of that property is $450,000. So if you've got a property with $300,000 debt, but it's worth $450,000, then you need to figure out how are you going to take over this deal, because it's not as simple as just walking in and saying, hey, I'm going to assume your mortgage, say $300,000, because the seller is going to say, well, wait a minute, what about my other $150,000 that's owed to me? So to clear up this difference in what we call the equity gap, you have to come to the table already anticipating that to make sure you know how that's going to work. Now, what are some of the ways in which you can clear that equity gap? Now, one way in which you can do it is structure the deal as a seller carryback. So what you'll say to the seller is this: listen, okay, $450,000. If you want $450,000 on this property, in fact, maybe I'll even give you a little more on this property, but in exchange for that, here's what I'm asking for: that you carry a second on the property for that $150,000, or maybe you juiced it up another $5,000 or $10,000, and I'll give you a 5% interest rate on that. So now you assume the original interest rate on the bulk of the money at $300,000 at, say, 3% with the VA, and then the seller, you're paying them as well on the difference on that second loan that they took back, which is called a seller carryback. So maybe you structure that for 10 years at, as I stated, at 5% interest. Now the advantage to the seller is now they're going to get cash flow. Now, the only time you're going to run into problems here, right, is if you don't understand what they're trying to solve for, why they're looking to sell the property. If it's because they want to move and they need that cash to roll into another property, well, then that probably is not going to work for that particular seller because they were banking on that. And so in that situation, you're going to have to come to the table with cash, or you're going to have to find a private lender to help you fund that deal. But if you can get that to work in the way I just described, then you know you're going to be able to take that and assume that loan and get that seller paid off. Now, from the asset protection piece of this deal, all right, so when you're doing these VA loans, here's something that's really important. You see, when they're underwritten for owner-occupied. That is, the veteran's going to treat it as their personal residence. So if I'm trying to put a deal together like this, there's going to typically be a restriction in that VA loan assumption that you are going to treat it as your personal residence. So you have to come to grips with that you may have to move into it, or maybe it's treated as a secondary residence. Possibly you can work around it. But whatever the fact is, you're not going to be able to buy it as an investment property initially. It doesn't mean these can't convert later on. So you can originally buy the property, intend to treat it as your personal residence, and then turn it into a rental property after the fact. In fact, I've run into many military investors who have built their portfolios with VA loans by doing that. Now, what about the asset protection piece? Well, because of the fact that you have to take title and treat it as a residence, you're going to have to close in your own name. So you're not going to be able to use a limited liability company or a land trust. Now, after you've closed on it, then your next step should be to transfer the property into a land trust. Now, if you watch or you've reviewed my channel, you know I have lots of videos on how to structure property with land trusts. And this is what I would do, because the land trust, it's acceptable to the VA. You can put properties into trust. You would never call it a land trust. You just refer to it as a grantor trust. And so after you've already assumed the loan, your next step would be to set up a land trust with privacy and then transfer that property into the trust. So it gets your name off the public record. And so once that property is held in the trust, then what you're going to do is assign your beneficial interest to a limited liability company, because you want to make sure that if something were to happen on that property, that you're not going to be personally liable. And this is where I see investors make the mistake when they first start using land trusts. They don't understand many times that assignment of beneficial interest over the LLC, that's where your asset protection is. It's not just you're merely holding it in the land trust itself. The land trust offers you anonymity. It doesn't give you the asset protection. So in order to get that, you have to move the beneficial interest over to a limited liability company to make sure it's fully protected in case something happens on the property itself. Now, there's one other thing I want to warn you about in doing these VA loans. I talked earlier about the lender letting the veteran off. Okay, well, this is what is referred to many times as the entitlement trap, and it is a big risk for the seller. And you probably should explain it to them, or the deal may blow up when they start talking to the VA about the loan assumption process. You see, when a veteran lets a non-veteran assume their loan, the veteran's entitlement, okay, that is the government guarantee, stays tied up in the property until the loan is paid off. Okay, this means that the seller might not be able to get another VA loan for their next property. So you probably should disclose this. And if the seller is an older couple moving into a retirement home or downsizing, they may not care. But if it's a younger individual and they're still active duty and they're just moving to a new station, they're PCSing across the country, it could be a deal killer for them. So before you go too far down the road on putting these deals together, you need to be aware of this. You need to ask them up front, hey, are you planning to use your VA benefit for your next property? And if the answer is yes, you can't assume their loan unless you're also a veteran who can substitute your own entitlement. Okay, so you got to be honest up front, or what's going to happen is you're going to spend a lot of time on this deal only to find out on the back end that the seller is going to back out of the deal because of that entitlement issue. All right, so it's pretty straightforward. If you can qualify with the VA for the loan, you can lock up these low interest rates. You just got to make sure you're bridging the equity gap here in these properties if you're going to go out there and look to do this rather than the subject to route. And then make sure you're letting the seller know about the entitlement. And then once that's done, make sure you get it protected by putting it into a land trust and then wrapping that under a limited liability company. Hey, if you want to learn more about how to set up this type of strategies and others, I would like to invite you to a free strategy session. Hey, it's completely free. You can talk to one of my team members about your asset protection or investing strategies, and we'll show you the best way to structure it from a legal and tax perspective. If you want to take advantage of that, all you got to do is look in the show notes. I have a link down there. Just click on that. Like I said, 45-minute strategy session, completely free. Let us help you protect your assets and improve your investing. Take care.